I'm going to start off with a bit of good news. We were originally going to be 4 panelists, not including myself. We're down to 2. And I know how much the organizers will appreciate this, but we were running a little bit behind the schedule. So I'm going to give us some time back. So we're not going to speak for the 25 minutes that we were due to be speaking. We're going to probably speak for about 15 minutes plus a little bit. The private capital market, as we all know, has been through a decade plus of explosive growth. So there's about $23 trillion worth spread across the private capital markets at the moment. By contrast, a little over a decade ago, that was less than 10 trillion. What we're going to do today, and we're going to split this into kind of 2 bits, the sort of the equity component, private equity and venture capital, as it is related, look at kind of what has happened, what were the drivers that got us there, but specifically what's happened just most recently. We're looking at the turbulence and asking that question, is this just a bump and we go back to how it always was, or is there just something very, very fundamental that's shifted here? And we're going to look at the same in private credit, where there's just been some sort of explosive growth there. In fact, it is probably the hottest of the hot sectors in private credit over most recent years. So we're going to divide it up that way a little bit. But Kate, let me start with you then on the equity side. And I know, your association looks less at the sort of the most developed markets. I'm choosing my words carefully because I know you don't like the term emerging markets, and I'm sure you're going to tell us why. But let's just sort of understand what's been happening in, say, the past 5 years. I mean, we heard that term, fear of missing out. There's no doubt about the wall of money that was thrown at private markets. A number of different reasons for that. Perhaps you might want to cover those. But the era of cheap money was a big driver for that. So where are we kind of now? But what were the drivers that got us there that people were afraid of missing out of? And then kind of what does a reset look like now that has happened in the past 12 months?
Well, I think, it's no secret we've seen 20 years of a dramatic increase in private capital activity globally, but particularly, in the US. And with 0% interest rates and leverage readily available, financial engineering drove a lot of the profits and the returns that we saw out of the U.S. It's going to be a much more complex environment going forward. And I think that anyone who's predicting a return to normal is going to be sadly disappointed. I think there is no normal, sort of waiting on the other side. The scale of capital to be invested globally, it's about 1.3 trillion that's raised just by private capital fund managers each year. But in addition to that, you've got to take into consideration all of the sovereign money, not only from this part of the world, but from places like Singapore. You've got Canadian pension plans. You've got all of the billionaires that have been minted in past generation. So all of that capital is, it's a challenge to put it to work. And you're right. My organization was founded as the Emerging Markets Private Equity Association in the early 2000s by the IFC at the World Bank. I've been hearing this terminology, emerging markets, referenced again and again this morning. I don't know why. I mean, so often language is the enemy of understanding and doing things well. You can't define 88% of the world's population as emerging. China is the world's second largest economy. I leave New York, where I live, and see digital payments light years ahead of where we are in the United States, in Asia and other parts of the world. I also see infrastructure that's far more advanced than we have in the U.S. You look at where wealth creation comes from. Frankly, who's here in Abu Dhabi this week? I think that there is a fundamental shift underway. And so what I would highlight in terms of looking forward is, in the markets that we cover in Asia, Africa, Latin America, the Middle East, Central and Eastern Europe, financial engineering has never been part of the playbook. There is no leverage in those markets. And I think everyone's predicting in the US and globally, operational capabilities are going to be absolutely key to delivering returns going forward. And I would argue that there's a much better opportunity to put money to work productively in other places outside the US and Western Europe today, just from the place that we're starting from.
Thank you. And so we started off today with presentation on the 10 rules of what makes a successful nation. I just, given that, where you look at, you started off in Latin America, but within the emerging markets or not, depending on what term we use, where are you seeing it from your members? Where are they finding the most interesting opportunities amongst those developing economies at the moment? And did they match up with the results that we saw
I
from the
love that
first
you're
meeting?
asking me that. It's a great question. I'm going to throw it out completely. No one thinks about investing that way anymore. It's not about geographies. You don't say, institutional investors don't say today, I'm going to put 10 in Brazil and 20 in India. What they think about is thematic investing. And the major driver of deployment of capital today is the climate crisis and the opportunity to back the energy transition. This represents an opportunity to put trillions and trillions of dollars to work, not only in new sustainable infrastructure and the energy transition itself through renewables, but the reinvention of manufacturing, food and agribusiness. I mean, there's an enormous amount of capital that needs to be invested. Where can you do that most productively? Where do you find the managers, the fund managers that are responsible for delivering that performance? So who do you trust in the market that you're investing in? And then the other big theme is everything related to technology, digitization, and innovation. I've got another panel after where we're talking about healthcare and life sciences. I mean, AI is going to drive apparently just incredible innovation in what we're going to see in life sciences going forward. You have places like India where they've created UPI. The government has created this universal payments infrastructure that is driving, massive investment in fintech, which is one of the big thematic drivers going forward as well. There's another example in Brazil with Pix, which was created by the Central Bank of Brazil. So fintech, climate, health tech, digitization of traditional businesses, private credit, which I'll let my co-panelists speak about. It's much more sectorally focused rather than geographically. Now, we'll make one exception, which is we know there's been a massive shift in China, and there's a reorganization of supply chains going on globally. I believe some of the other panels may have addressed this. So for sure, we see shifting private capital flows with a shift in China, the opportunity to reorganize supply chains, and a focus on India in many cases now.
Yeah. I mean, I think there are some geographical themes you can pick up on, particularly around the demographics of where you're more likely to find entrepreneurs and indeed consumers of new and innovative products. But point well taken. Let's switch, Rohit, to private credit, and an area that I know a little bit about, given that my association also covers private credit. And we've written a report recently where we have predicted that private credit in fund form will overtake private equity by the end of this decade, if not very much before. So it has grown enormously at what we're approaching $2 trillion worth of AUM in private credit funds. What you're doing is somewhat different. You're an entrepreneur first and foremost. You created Biz to Credit, but what you are doing is you are lending to SMEs. Tell us a little bit about about your business, what it was like being an entrepreneur setting it up, and actually whether in this non-new normal it would be more difficult now as an entrepreneur to set that up.
Yeah, so I think there are two things. So as an entrepreneur, when we set up Biz to Credit, there was a lot of VC money / private equity money, and not much private credit. 2008 was a trigger point because of regulatory pressures when private credit market started coming in, but because of money being so cheap, people were looking for returns, and equity was much better than private credit. Last 3-4 years, we have seen a major shift already starting to happen even before Fed starting increasing the interest rates. There was a recent McKinsey report which said that 75% of new credit has been created outside of the banking system, which is massive, shift, because most of the credit was deposit money or bonds, 81 bonds and other things, that banks were doing. And I think there are 3 or 4 big reasons, and the Fed interest rate increase has just accelerated that, phenomena. One, obviously, after 2008, a lot of banks withdrew from a lot of lending piece of the business, especially in the SME space, because Basel III came in and other regulatory aspects came in, and banks were not just equipped doing it. The second thing is banks have been behind in digitization. COVID has accelerated the whole, the digitization of the customers, the businesses, everybody. And banks are just, now trying to catch up with that. So what was a regulatory arbitrage for a lot of banks has become a big disadvantage. What we are seeing in US, and my experience has been that what starts in US spreads across the world, it takes some time, is that we are going to see a massive amount of consolidation of banks now, especially regional and super regionals. Their cost of deposits have just gone up to 6.5% now, if I take into account branch networks, IT, infrastructure cost. And they cannot lend money at more than 9 or 10% because they're not used to that. Their models will not allow it. Their technology doesn't allow it. And that whole spread that they used to have, like 6-7% spread, has now shrunk to 3.5% kind of a spread at a gross level. And what is happening with private credit is fascinating because a lot of people are moving their money out from bank deposits and putting it in other instruments because everything has gone digital and online. And that's where, and especially insurance. So as the Western world ages, as longevity goes up, a lot of insurance money has to now buy the assets which can match their liabilities. And that's where, somebody like, say, Apollo, when they transformed themselves from a private equity player into a private credit player with the acquisition of, say, Athene, and that started the whole process. Now, not many people know, but today Blackstone, KKR, you name any big private equity firm in US, they have bought a stake in an insurance company and they're moving dramatically over to private credit business. Few reasons: less regulated, better returns with increasing interest rates. The returns have gone up. Equity markets have softened a lot, especially both public as well as private markets. And if you can get a return of 13-14%. So what we are seeing in our business is that when we started the business, we used to fund small business or SME customers who used to go to a bank first. If they didn't get money or a loan or a lending product, then they used to come to a player like us. Now it has turned upside down. So much so that, we have so much private credit money, insurance money, pension fund money, endowment money also starting to come in. And as the world has gone digital, people are more willing to share data. Now AI is going to accentuate it even further. And the biggest change that we are seeing is that banks themselves are struggling. So they are coming to us now and saying that we need capital relief. So which is like, banks coming to players like us and saying that we need access to capital because we cannot keep lending money to our own customer base, and we cannot afford to lose them also because if we sell those portfolios, we're going to lose them. Now that's a very interesting paradigm shift. I foresee this is going to just accelerate from here, and private credit is going to become a much, much bigger part because if the interest rates are going to be where they are for next 12 to 18 months, the market will totally shift away.
So that's here to stay. Can I just ask a quick question about kind of risk? Because for borrowers to service debts in a higher interest rate environment, when you look at your loan book, as it were, have you seen any material change in the credit quality of that? Are you having to do a lot more work on restructuring with your borrowers?
So what we have seen is the US economy has held up pretty well till now. Having said that, what we always see is that when there is so much of capital available one way or the other, people make mistakes. There is a fear of missing out. People will start lowering standards. They will start, originating more or buying more of these loans. And that's where the crisis really starts. So I think we are still in early stages of that. Having said that, private credit market is very lightly regulated, compared to banks. So that's a risk that's there. And my view is that if we keep seeing interest rates at this level for an extended time period, then yes, we will see some blow-ups will also happen. And I think the other big challenge would be that a lot of private credit funds that are getting now set up, you cannot do it with the mindset of private equity. It's a very different business, So that's where it's not like you can have some hits and some misses and you can make some outsized return from few of your investment. It's a more steady, ongoing kind of a business where you have to be very disciplined and also think that, how can you get the money back in a time-bound fashion? Because if it gets delayed by 3 or 4 years, then your returns to your LPs is going to diminish quite significantly.
Good. See, we have come right at the end of our time, and I promised to give some back. But I just want to ask you, Kate, one last question. And I think we picked up on the fact, we're not going back to any sense of normal of how it was before. And I think McKinsey, there was a McKinsey report I was reading saying the music, and this is specifically private equity, that the music hasn't stopped, but it's been turned way down. I wonder if that needs an addendum to it, and whether you would agree that actually not only that, but it's perhaps the radio's been tuned to a slightly different wavelength, which we better get used to from here. Would you agree with that?
Well, I guess, two large observations. One, time horizons have changed so fundamentally in terms of thinking of a 3 or a 5 or even a 10-year investment horizon. Those investment horizons are getting pushed out longer and longer. And then, of course, you have all of this institutional capital from places like Singapore and the Middle East, where they don't think in terms of, again, a 5 or a 10-year horizon, but they're looking decades and decades out into the future. And if you're trying to predict what to invest in and thinking about the return on that capital, the risk of that capital in a 20-year horizon, it's very different from thinking about what am I going to make money on today and what will I be able to list or exit in the market today. So that's certainly, and then the other one would be the relationship between institutional investors and fund managers. More and more institutional investors are investing directly, they're co-investing. So the relationships between GPs and LPs is fundamentally changing. And I think there'll still be a piece of that will stay in place. It's not like the industry is going away by any sense of the imagination. But I think trying to predict simply, what's coming in the future based on the past is a fool's game.
Excellent. Listen, I think we'll have to leave it there. Kate, Rohit, thank you very, very much indeed. I know it's a bit of a gallop through, but really appreciate your time.
Great. Thank you. It was wonderful to be here.